Hello everyone, it's Friday, February 20, and today we will analyze the charts for the euro and the British pound to assess potential market moves. Yesterday, the euro weakened against the US dollar. A brief uptick in early trade was following by a sharp sell-off during the American session. The British pound mirrored this trend, weighed down by growing expectations that the Bank of England will cut interest rate at its next meeting. Meanwhile, US rate cut expectations have diminished, supporting the greenback. Economic data from the US also pointed to solid growth. Weekly initial jobless claims for February rose by just 206,000, falling short of the projected 223,000, and marking a decrease from the previous 229,000. This stronger-than-expected print bolstered demand for the dollar. In addition, the Federal Reserve Bank of Philadelphia reported a rise in its monthly manufacturing index to 16.3, well above the expected 7.5, further supporting the dollar. However, the U.S. trade deficit widened sharply, raising concerns that President Donald Trump's tariffs are not achieving the intended results. On the Fed front, Neil Kashkari criticized Kevin Hassett, director of the National Economic Council, for continuing to exert pressure on the central bank, despite Fed Chair Jerome Powell's impending departure in May. Kashkari refrained from commenting on future policy steps, which contributed to a reduction in rate cut expectations and sparked strong dollar buying activity in the market. Now, let's take a look at today's macroeconomic calendar. In the UK, retail sales data is due with a modest 0.2% growth forecast for January. This could signal slowing economic growth and easing price pressures, potentially prompting the Bank of England to cut interest rates again in a bid to support the labour market and overall economic activity. Additionally, the UK is set to release figures on public sector net borrowing. Weaker than expected prints could add to the pressure on the British pound. In the euro area, a full slate of data is on the docket, including February's manufacturing, services and composite PMIs. Reports on business activity will also come from France, Germany and the UK. Given the volume of data, it is expected that market volatility will remain high throughout the day. Across the Atlantic, the focus will be on US GDP growth for the fourth quarter of 2025, with expectations for the slowdown to 3% from 4.4% in the third quarter. A stronger-than-expected slowdown could put the dollar under pressure, reversing some of its recent gains. Also in focus will be U.S. Personal Consumption Expenditures (PCE) price index, which is expected to rise 2.9% year-on-year on December. Traders will also be keeping an eye on personal income and spending data, along with the latest PMI figures. With so many important releases on the horizon, price fluctuations are expected to intensify. Given market uncertainty, I would advise caution when trading today, focusing more on an analysis and waiting until next week to make more definitive trading decisions. Turning to technical analysis, the 1-hour EUR USD chart shows that the euro has fallen sharply against the US dollar. The focus is now on defending the 1.1745 level. A false breakout of this mark would trigger a buy signal, potentially pushing the euro back up to 1767. Upbeat data from the euro area could help the price break above this level, extending gains to 1787. The most distant target would be 1807, where I would recommend going short on the rebound, targeting a 15-20 pip move. Short entries at 1767 and 1787 should only be considered after a false breakout. Conversely, a break and hold below 1745 would likely drag the euro down to 1719, with further potential to reach 1697. At this level, it would be prudent to consider a long positions on a rebound, aiming for an intraday correction of 20-25 pips. Going long at 17.19 and 17.45 would only be relevant on the false breakout amid weak US data. Regarding the British pound, the situation is quite similar. A false breakout at 1.3432 combined with positive UK data would generate a buy signal, potentially pushing sterling up to 34.60. A break above this level could take the pound to 34.89 and potentially open the path to 1.3515. At this level, it would make sense to go short on the rebound, targeting a 20-25 pip move. Short entries at 34.60 and 34.89 should only be considered under false breakout. If UK data disappoints, a break and hold below 34.32 would likely push the British currency down to 1.3409 with the potential to reach 33.84. At this mark, I would recommend going long on a rebound, targeting a 20-25 pip move. Long entries at 1.3409 and 34.32 against the trend should be approached with caution only after confirming a false breakout. Good luck to everyone. Have a great weekend.